So this is going to be a little bit complex, but we wanted to post up the presentation, and I wanted to make sure that you can actually see the data that I'm talking about. So what happened? In the fourth quarter of 2024, the price of strategy rocketed up. And we saw these massive gains that happened, and then the price dropped back down. And what I had to do was figure out what happened. So at that point, I worked with Dan, and I said, Dan, I need you to get access to the option chain, hit the API, and export that data. Dan's like, that's no problem. What do you want? I want the strikes that started at $100 that go up to $1,000, and give it to me. And once he did that in 5 minutes, I did it old school way by using sheets on Google Sheets instead of Excel. And then I analyzed the data. And what happened is that it was not the highest strikes that performed the best. Okay. And so when I looked at that data, it became obvious that the $400 strikes were the best, even though they tend to lose delta as the price goes higher. So based upon this information, I then took took an image that existed on the internet, delta versus gamma, which existed before. It combines both of them. So the gamma is the dotted blue line, and then you have the red line, the red line is the delta. And so when you look at this, the sweet spot, this is the part that I invented, is full gamma. And the full gamma means that you buy a stock 10 to 20% out of the money, and by a like return has to do 10 to 20% in the money. That's the full gamma. What happened in fourth quarter, as the price went up, those stocks never went in, those option trades never went in the money. So even though I was looking at my account and the highest strikes were doing almost double what the lower strikes were doing, that information was a little bit deceiving. So that's what happened. So we did this. So I posted this back on January 2nd. Do the people in the audience, do you remember this post? Does anybody remember this post? There's a few people. So I have always been, I would say, interested, amazed, trying to figure out how billionaires are able to keep their stock. And what I wanted to know is, how do they borrow against that stock? So one of the guys had called me back in June, and he gives me his pitch, cold calls me, and I said, okay, that's fine. Thank you for your pitch. Would you like to, I could tell you what I do. And I tell him what I do, and he goes, what do you want to do? I want to be able to post my shares as collateral. And so we went down a couple paths, and it took a while. That was in June. This was posted in January, so 6 months later. Why do I post this? It doesn't happen immediately. You have to do the homework and go figure things out. So I went to go see them, and what happened is they would never do what I did. They would never advise a client to have a concentrated position in one stock. They cannot do that. If you do that, they want to talk to you. And why do they want to talk to you? As most people know, I'm a Silicon Valley guy. I'm based out of San Francisco. So the Mag 7 companies, the executives of those companies acquire a massive amount of shares. If they go sell those shares, people are like, well, if they're selling the shares, they must know something, then let's dump the stock. So what do those early founders of companies do? They post those shares as collateral, and then they borrow against it. And that's what I wanted to do. And so they came back to me and they said, there's something called a variable forward sale. And a variable forward sale, the way it works here, it's a bespoke contract and allows you to post up collateral of your shares. And there is a minimum contract value, and it's non-taxable at inception. And as the time goes by, you can either buy it back or you can continue to roll it. So how many people think in the audience that strategy shares are going to be 50% higher in 3 years? Okay. So what's really interesting about this is that there's no interest or payments, and the more volatile the security is, the more they like it, which is the exact opposite of what everybody's probably been told in this in this room, that, oh, if it's super volatile, stay away from it. No, they want the volatility. And the reason why they want the volatility is because they can make a market in it. If it's dull, then it's hard to do it. And so the mechanics of it is they delta hedge it. Okay. And you could see there's a 90 to 150% put call collar that's put on it. Now, I am doing on a smaller scale the exact same thing that Saylor does, except he does it with Bitcoin. Okay. So he puts Bitcoin on the balance sheet. The multiple NAV goes up. The stock price goes up because it's leveraged, right? And then what does he do? He hits the ATM, extracts the volatility, and he buys a low volatility asset. What's a low volatility asset? Bitcoin. Because if strategy is trading at 2-to-1 MNAV or a higher multiple, that's more volatile. It's 2-to-1. And what does he do? He then buys the less volatile asset, which is Bitcoin. Why do I do this? I've been in this space now for 8 years. Bitcoin is no longer volatile enough for me. Strategy stock is no longer volatile enough for me. Options. I need to be in options. And that's why I met this guy, because he's brilliant. And I said, Dan, I need to do this. And he's like, okay, what are you trying to do? And so I explained it to him. So where are we now? So I have a new plan. One of the things about me is that I am able to change my thinking based upon new information. The more things I learn, the more likely I'm going to change and do something differently. Most people stick, and this is the reason why in this group we're all normal, right? But as soon as you leave here and go home, people think you're crazy, okay? So for me, you were all able to change your thinking. Everybody in this room has already won. You can all take your victory lap. Right? And the reason why you're in the room is because you changed your thinking from the normal people outside the room, and this is the new normal. So what am I going to do? I'm going to do a variable forward sale. I've already done it 3 years out. Okay? Now, the crazy part about this is when I started talking about this, I needed some experts. I called Dan. I send it off to Jeff Park, and I'm talking to Jeff in New York. And I said, I'm going to do this variable forward sale. It's 3 years out. And he looks at me and he goes, you're short gamma. I'm like, what? I'm like, of course I'm short gamma. And he goes, Brain, I didn't think you would do that. And I'm like, I don't really know what that means. So I had to put some thought into this. And my thought process is what you see here. On the far end, I'm short gamma because it's a 3-year contract. It only has to go up 50%. Right? And we have to go up 50% 3 years from now. So the gamma is the blue dotted line. But now I get to use my other funds to go long gamma. And that's what Jeff was asking me. What he was asking me was, am I going to just put all my money in there and coast? I'm like, no, I wouldn't do that. But I didn't understand the context of his question for a week or two later. So now I go long gamma, which is near dated, and you can see the difference in the two curves. And then you can see the comparison with delta, and you can see the rate of change that the orange delta is much steeper. And this is all graphed like this. The other important thing that you're going to see on the next few slides is that, how do I get this drawn? I ask Grok and Chat GPT. I talk to them on a daily basis. It's called Chat GPT because you're supposed to chat with it. That's the naming. I didn't know that. So I ask these questions. I keep on asking these questions. What does this mean? And it gives me prompts back. So then I say, this is what I'm going to do. I'm going to do this. I'm going to arbitrage the near and far dated variable forward sale contracts. So if you look over here, the AI key insight, okay? This part, if you look in the bottom, those are the prompts. That's the prompts that I typed into AI. The underlying stock price at entry is $80. The strike price is $100. The final stock price before expiration is $120 in the money. Now the math is really simple. If it's $80 and goes up approximately 20%, well, that would be 96. But basically, it's about whatever 23% up. But if it goes to 120, then it's 20% in the money, 20% out, 20% in, full gamma. So now I give it the prompts and I say, I tell the option premium price, I gave it some dollar amounts, and I said, I want you to compare 120-day expiration, okay, to 3 years to expiration. And it produces the table at the top. I didn't calculate any of this. I asked the prompts and it gives me the table. And then I look at the table and I say, you know what would be better? Because somebody wants to see a graph. I just say, graph it. And it produces the graph on the bottom. That's what I did. If you think that I'm just trying to talk to incredibly smart people, there's lots of them in the audience, right? I'm doing that, but I use AI every single day. And if I don't get a good response, I keep on trying. If it doesn't work, I wake up the next day and I try again. So this is what I want everybody in the room to do. If you want to ask, what would Grain do about this? You could just copy my tweet and go, Grok, what does Grain mean? And it will give you an answer. And I've seen multiple people do this, and it's typically 95% right. If you don't know what full gamma is, and I talk about it, just say to Grok, you'll put in grain of salt. What does full gamma mean? And it tells you exactly what I already said, right? And so when you see this, if you don't understand this, that is okay. Ask AI and keep on asking it. Your job will not be replaced by AI, but your job will be replaced by a person using AI. That is the fundamental shift. That's the most important part of what I'm talking about here. I would love to talk about cars, right? I would like to buy people some more cars, but now the bar is set even higher, right? Because it's no longer about being brilliant, it's how well you use AI. So where are we here? This is the easier slide to look at. And this is but just delta versus strike and gamma versus strike showing you over the time frame. Again, I did not make these charts. I just say simplify. I say in there, this was Chat GPT. I say, we'll simplify it and split it into two charts. Okay. And if I want to spend more time, I can make the colors for the solid lines and the dotted lines match, but I didn't need to do it. So these charts are all drawn by AI. So here's the key takeaway. A near-dated option contract will be long gamma. Long gamma is what you could see in the big orange spike that goes up the bell curve. And then the far-dated contracts are short gamma. Now, the benefit of being short gamma is that your delta curve is much more gradual. And for me, what I am doing is I'm not doing options here versus anybody in the audience. I'm doing options on strategy versus the future and versus the near future. That's what I'm doing. I'm arbitraging the difference between those price discrepancies. And if you do a call option, it's the same thing. You're posting collateral, right? And if it gets called away, you make money on it and the person buys and gets the stock at an agreed upon price. The catch with that's a taxable event if that's in a taxable account. I'm not giving any financial advice or any taxing information, but the catch with a covered call is it could trigger a taxable event. And I wanted to do what the billionaires do. I wanted to be able to post collateral of those shares, strategy shares, and extract out the volatility. Here's my last slide, and then we'll take a few questions. On April 25th, I made this slide out of Achilles Intelligence. One of the things that I did is that if you ask people, how do you trade? What metrics do you look at? You'll probably get 50 different metrics. I was at dinner with Jordy Visser, first time I met him. And I said to him, what metrics do you use? He goes, I use a lot of metrics. I go, what's your favorite metric? And so he gave me an answer and he goes, what's your favorite metric? And I like MACD and I compare it against the 50 and 200-day moving average, a death cross and a golden cross. And I said, well, we have a death cross on the S&P 500. Of course, he knew that. I go, but on the daily MACD, given the default settings, that the histogram went green. And he looks at me like, smiles. I'm like, thank you. Somebody understands what I just said. And so for me, that was incredibly exciting. And then he said to me, the way you get good at pattern recognition is not by learning a zillion new metrics. It's by keeping the same metrics over time and seeing it time and time again as it goes through a cycle. And that's how you get good at pattern recognition. Some people will call that intelligence. I call that experience. I would rather have lots of experience and some pretty good intelligence than the reverse. Typically doesn't work well that way. Typically, the super intelligent people are like, you're buying these magical Bitcoins. That doesn't make any sense, right? I'm sure you've all come across incredibly smart people. You try and explain this to them, and they're like, I don't get it. I'm like, what don't you get about monetary debasement and inflation? So with that, on April 25th, Strategy was at 276. This was done as of Friday. It was at 394. I entered that trade at 262. Basically, I'm up 50% on a 3-year contract in effectively a week and a half. And it was short gamma. It's going to continue to be in the money. What am I going to do? I'm going to roll that. I'm either going to roll it or buy it back. And I'm going to continue to do this over and over again. There's this guy, Michael Saylor. What does he do? He continues to want the stock price to go up. As it goes up and trades at a higher MNAB, he extracts that volatility and buys the low volatility instrument, which is Bitcoin. That's his plan. He's told to everybody, 93 slides. So this is my last slide. And the important part about this is don't wait. You got a 50% jump in a very short period of time, right? And so if you keep on waiting for the next bull run, right, the implied volatility will spike. It'll be expensive to get in, and then you'll get lower gains. Why do I make better returns than other people? Is because I buy when the market is crappy. Really? I mean, from that perspective, it is really difficult to do that, but you move a large position, you buy it with the conviction that it's going to go up. But what's different now is I'm arbitraging between the near and far dated. And that's something with which I really didn't do before as effectively. I'll leave with this. A near dated option for me is 120 days out. It's not 30 days. It's not weekly. That's my minimum expiration time frame. So let me stop there. You guys are on stage with me. You can ask me any questions.
Yeah, give me the, so let's say we're thinking strategy goes to 1,000 at some point, and you've got the, and so you capture the full gamma, you ride it up and down. Are you going to roll those up to, and kind of anticipating that we're going to, or you're going to move to shares or something else?
Okay, so what happened in the fourth quarter? That's a great question. In the fourth quarter, I was buying the 150s, 200 calls, right? It was trading low. And I've talked to Josh Mandel a few times, and I said, what happens if I want to deploy particularly a certain amount of money? He said, buy the 200s because it wasn't that high. It seemed pretty simplistic. So I bought that. What happened is as the price blew through 300, right? It was 50% now in the money because it's a $200 call trading at 300. It began to lose that delta acceleration. So what I did was I began taking some of the money there and buying higher strikes. So then I bought the 300s, the 400s, the 500s, 800s, 990s, 1080s, right? And the number got bigger and bigger and bigger. In this particular cycle, I think I'll ratchet that back a little bit. Okay. But with that, you have to show some form of restraint. But what I do think is going to happen in the short term, approximately July 20th, is when they have to announce the Strategic Bitcoin Reserve or the Working Group Sovereign Wealth Fund. That comes out in July. S&P 500, possible inclusion, right? Q2 numbers will close out the end of June. If Bitcoin's above 96,000, then we'll start that. And you'll have this short-term pump that will happen. If it's over the summer, I would probably not go ratchet up to higher and higher strikes at that point. I'll probably wait more into the fall.
So Graham, when you're thinking about arbitraging the gamma, as you said, and arbitraging kind of a calendar spread between going short volatility in the long term, but long volatility in the short term, what are you looking for? Like, what sort of catalyst? Are you looking at like TA metrics? You're looking at volume? You're looking at like fundamentals of the stock? How do you choose those shorter dated options?
Sure. Great question about the shorter dated options. People look at the implied volatility, and I'll go back. Actually, I was talking about the 50 and 200 day moving average. Why do I like moving averages? Because it takes into account all known and unknown information. And so if you look at this, at the peak cycle, you see the 2.37x. That happened in early April last year. Strategy traded 2.37 times the 50-day moving average. But what happened is in the fourth quarter, it only hit 2.12 times the 50-day moving average. people are using a zillion metrics to explain this to me. And I'm like, to me, that looks a little bit like diminishing returns. I thought that it could have gone higher given the triple Q inclusion. So you're like, what is the catalyst? Triple Q inclusion. Do I think it's going to trade higher than 2.37x? Right, because that was after the spot Bitcoin ETFs got approved. So I thought it was going to run higher, and then it didn't. And why didn't it run higher? Probably because of the ATM, and that's fine. So those are the metrics that I look at. On this, it just shows the multiple of the 50-day moving average. 50 days is a pretty short time frame. If you look at the green, it's the green dotted line. If you look at the bottom chart, you can see over there we're now at 1.3 times the 50-day moving average, whereas on the 25th, it was 0.90, which was trading below the 50-day moving average. So that shift happened. So why do I like the 50-day moving average, the 200-day moving average? Who here has been in Bitcoin for a while? Okay, the Meyer multiple, Trace Mayer, right? If Bitcoin is 2.4 times the 200-day moving average, it's a little bit overheated. You should buy it below the 200-day moving average if it's below 2.4. And that's why when I saw that, I did not know in 2017 how you model an asset or a commodity like Bitcoin. And that's why, because you can't look at quarterly reports. And so from that perspective, I'm like, oh, you're going to compare it against the 50 or the 200-day moving averages. And that's the metric that I really like because there's no CEO for it.
Yeah, I don't have any more questions, but I just want to say this is the first time I've seen these slides, and this will come up later. Like, this was not scripted. We didn't coordinate. But my slide is going to match perfectly with that 120 days that you said is the earliest that you are going to go with Gamma. And so I was just like, you see, that's pretty cool.
Right. And I did not want to share this presentation before I gave it. So with that said, I would like to take any questions from the audience real fast. If anybody has some quick questions, right here.
When you're looking to buy an MSTR option, they're what, $5 or $10 increments, but you've got in the open interest at certain increments that's much higher, which I presume gives you more liquidity. So do you strategize the strikes that you want to buy based on open interest and sort of a perspective on the market? And then how do you get in? But more importantly, how do you ratchet out? Like if you've got 1,600 calls for whatever month, doesn't matter. That's a big position. Even with potential liquidity, you can still, I found, have dead zones in trying to get out of a large position if you want to. And how do you conceptualize that?
Sure. I think all three of us will have an answer for you on that question. So the question revolves around when you look at the different strike prices, you can compare the volume versus the open interest. The volume is the amount of times that particular strike trades in a given day. The open interest is the contracts that remain open after that happens. So at the end of the day, the next day, the open interest shows you the number of contracts that exist for that strike. What you'll tend to see is around round numbers. $100, $150, $200, you'll tend to see high OI on that. What I can tell you is that if your position is very high and there's not a lot of OI in it, sometimes it takes harder to sell. I use market orders. I never use limit orders because it's not going to make a difference if I save $100. It just doesn't. So for me, I always do a market order. What I have found, my market orders are, if they're at a weirder price, they typically take longer for it to execute. And for me, I would rather get in and out quickly. I don't day trade. The last trade I did was, I don't know, a week and a half ago, 2 weeks ago. So I am not a day trader. But for me, when I make the conviction to go in, I want to execute fast. And when I go out, I want it to execute fast also. So it tends to be around round numbers. I think that if you were to go, let's say the round number is 150 and you pick 140, it doesn't seem like the 140 responds as well as the 150. And I think it has something to do with the market maker, the way that it prioritizes the orders.
The slippage is an issue, sir. If you want to get out. Not even at a rush. Just you're looking to phase out.
Right.
Worry about slippage versus getting the next.
Yeah. So the question was about slippage, which is the difference between the price you're seeing and the price it executes at. And I typically don't worry about that because it's not a big enough. If the trade is right, if If I'm buying something that's going to have a minimum expiration of 120 to 180 days out, that slippage should not make a difference.
Yeah, so you're hitting on an important point. So the two most important factors in an options trade, or really in the stock market in general, is going to be position size, number one. No single position should be enough to wreck you. And that's pretty hypocritical coming from me right now, because 90% of my portfolio is in strategy. So do with that what you will. But number two is liquidity, especially when you're talking about options, because it's generally pretty easy to get into an options trade. But when you win the trade, you also have to exit it in order to keep the money. So you're absolutely right to be looking at that. I would say that I don't foresee this changing anytime soon, but with strategy being the most highly traded option period in the market, you're not going to have to worry about liquidity on probably any strike of any expiration that you can find. I do use it for other stocks, when I was just kind of agnostic about what I traded. So you are right to look at it, but the phenomenon that Grain explained does kind of happen. So 150s, 125s, 175s, 200s, those are going to have a little bit more open interest and daily volume. So you could gravitate towards those, but a 260, 250, I get a fill every time I want to, get in or out of a strategy trade. The only time that it becomes an issue is if you start doing spreads. So buying or selling one option, you can just, I don't do market because I'm, pinching pennies a little bit more than Grain is. But, so I'll literally put it in 3 times trying to get the best price I can. And so if you multiply that, if you're doing a credit spread, some spreads maybe have 4 legs, you're going to have to kind of like massage that bid-ask spread times 4. So, definitely great question. And that's how I look at it.
You guys covered it.
Yeah. I've got one more point. So I'm going to go back to 2017. So 2017, I think it was May 17th, Brian Kelly goes on CNBC and he says, as everybody knows, and as soon as somebody says that, you have no idea what they're going to say next. So he says, as everybody knows, Bitcoin hit its all-time high of $2,000 last week. And I got into a lively discussion in December of 2014 with a person that worked with me that also went to MIT. It was not Michael Saylor. And we had a very lively discussion about the Bitcoin hash rate. And I knew what happened in 2014 with Mt. Gox. I did not buy any of it. And it was trading at approximately $240 a coin. And so there's 2 friends that were with me that I'm still friends with today. So then May 17th of 2017, hopefully I got the exact day right, Brian Kelly goes on CNBC and says, everybody knows Bitcoin at the all-time high of 2,000. And I'm like, oh my God, I missed the whole run. Just missed everything and then I remembered what happened. So the reason why we're talking about slippage here and why this is relevant, he said there's basically 3 ways you could buy Bitcoin. You could do Coinbase, you could do Grayscale Bitcoin Trust, you could buy it in your IRA account, your regular brokerage account. And then there was another way that he had a fund to do it, which was more like a derivative of what was happening. And I'm like, GBTC, Grayscale Bitcoin Trust. So I do an all-nighter the whole night. The next morning, because let's be realistic, a lot of people watch CNBC, and it was trading around $200. It was trading 50% premium, and it was OTC, meaning that you had to sign it, that it was like a penny stock. And it's a penny stock that opened the day at $200 and it went to $300. But because it was a penny stock in the sense of it traded on the pink sheets, right? What I had to do was I wanted to place an order, but I could not do a limit order. Sorry, I could not do a market order. I might just do a market order and buy it. But it had started at 200 and went to 300 in one day, 50% in one day. And I could not get an order filled. And within like 3 or 4 minutes, I'm like, well, this is just not working out because it was bound. You could see the spot price bouncing. So I'm like, I could game the algorithm very easily. And I'm like, it's trading at 200. I put a limit order in for 325, $100 above the spot price, which is completely insane. And it executed effectively as a market order. at 125 or whatever it was. Sorry, it executed at 225. So I did it $100 above. Think about that as slippage as spread. Completely absurd. And it executed immediately.
I've seen it on my buys too. You put a buy in the limit and it's a little bit lower, which is great.
Right. Yeah. So that's what happened. So we see these inefficiencies in the market. And what happens is you have to think, I want to get into this now. And I always knew in 2017, some point in the future, whenever it happens, right, that I would be on a stage someplace and say, oh, I did this in 2017. So I think it was Mason that was talking about time travel. I thought 10 years in the future or 8 years in the future, I would look back and say, why didn't I do more? Right? Because you always look back and you say, because hindsight is 2020 is perfect. And from that perspective, in 2017, I've already said this publicly, I did 100% of my IRA account. And that was 2017. And now I'm on stage with these guys.
It's great to be here, Grain. Is there another question? We have 5 minutes. I just want to, get a couple in.
I haven't found it with my options trading, but what is your collective opinion of the MSTY and now MST, IMST, and the effect that they'll have on the options market? Because as you know, MSTY, I think Jay is approaching 3 billion or more. Let's say we go out a few years, it's 6 or 20, however much it grows, and what effect that will have. And I understand that they're using synthetic options to create their position, so it's not the full assets of the fund that are in it. And at what point can that have an impact, positive, negatives, gamma squeeze anyway in MSTR?
Yeah, so there have been some credible people that I follow on X that think that those types of ETFs are dampening the vol. But I think it's just kind of kicking the can down the road, or like trying to hold a beach ball underwater. Eventually, those shorts get breached and they have to cover. So they're shorting now, but they're going to be a buyer in the future. MSTY is way more aggressive, so they're more of a premium play. Jury's still out on IMST, but you'll probably get more upside with them. The market's got people on both sides, and I'm fine with it.
I agree what he said. It's going to have a dampening effect in the short term. But what's going to happen at some point in the future, right? I can't tell you the exact date. There's going to be a step function, and anybody that has a covered call is going to be caught off guard. The price is going to rocket up, right? And they're going to do it at scale that did not exist in previous cycles. I cannot tell you the date that that's going to happen. What I can tell you is that I want to be positioned the day before. Okay? And I wake up in the morning and things are good.
Yeah, and my only follow-up is conceptually, if you look at the realized vol, which is the actual standard deviation of the daily returns over the past 30 days, it's 120%, 130%. So the volatility in the actual stock is totally there, right? And that volatility people have been claiming, it's the ATM has dampened the volatility. Well, it hasn't. The volatility is 130%. That's just, you can derive that from the price movements over the past 30 days. But then you have the implied vol, which is totally different, right? The implied vol is backed out of the price in the options market. So maybe there's a 20% out of the money call for 30 days into the future. It trades on the open market and there's a price made. You can, using the Black-Scholes, back out the implied volatility, or what the market expects the volatility, or what the market's willing to pay for the volatility for the next 30 days into the future. That's the difference between implied vol and realized vol. So right now, again, realized vol is 120% on the stock. Stock's volatile. But the options are trading at a 75, 80% implied vol for the future 30 days. So it goes to show you, the market's not buying volatility, it's selling volatility in one form or another. And so how do you position there? Do you jump into the crowded trade, or do you maybe take a different perspective?
Quick question, guys. We all have a sort of a bit of heartache from the $544 share price in November. As you guys think about it and we claw our way back up to that, how are you thinking about positioning vis-a-vis the new all-time high? What do you think the stock's going to do as it gets close and shortly thereafter? How do you think about it?
Well, as I've said before, I'm already positioned. I'm already in. I actually have very little cash. People ask, how do I have an infinite amount of cash? I don't have an infinite amount of cash. What I have is I have to change positions that I don't think are going to do as well, and then change the strike price and the expiration. So for me right now, I'm cautiously optimistic. It's already done well. It's already up 50% in a very short period of time. And so where do I think it's going? It's going higher. I think that the step function will most likely happen this year. And that's for a political reason, because there'll be another election the year after. So I think that you're going to have more exuberance this year. There's also, everybody that's been in Bitcoin for years knows that typically 18 months after the halving is the peak cycle. And then you show up at Thanksgiving and your idiot neighbor bought a brand new car, right? And they're like, they don't know anything, but they bought Bitcoin. And by the way, Tom Lee of Fundstrat said that. There's a lot of fund managers that will not buy Bitcoin because their neighbors got rich on it. Okay? That's what he said. So my view is the price is going higher. I think it's going to go, I think there'll be a step function, and then we'll hear the same narrative again. And then the next thing that comes up after that is, when's it going to drop so I can buy more? I don't know.
Yeah. I think the step function is accurate. These things are coming S curves, but what this is going to be is a series of S curves. I think it's like, you can't just say, oh, we're at the bottom of the S curve and it's going to go up. It's going to go up, and then there's going to be a pause and maybe some crashes, unfortunately. And then I don't know how many S curves it's going to be, but it's going to be a wild, volatile ride.
This is real world, right? The chart. But if I go back, this is what AI shows it as. Perfectly bell curves, right? And that's what AI generates, because it has to put some smoothing into it. But this is the world that we live in over here. It's these peaks and valleys, exactly what Soleil said. So that's what you have to think of. The AI can do this. You think that you're right. Therefore, you need the conviction to do it, to weather the storm through this. That's the difference.